We say good evening to our good friend Craig Bolanos. He is the co-founder, wealth advisor at VestGen Wealth Partners. Get retired, stayretired.com. Craig, hello. Happy Wednesday, my friend.
Hey, happy Wednesday. Happy New Year's. It's like the Super Bowl on Saturday when the Bears take on the Packers. But I think this economy is already celebrating because nothing can take Mr. Market down. Yeah, at least not yet.
Yeah, this is where I was going to start, Craig. I'm not the oldest guy here, but I do remember a time when uncertainty in geopolitics would lead to the market freaking out just a little bit. And where is that happening? And this isn't a statement, a value judgment about what the president decided to do or not about Maduro or where we go here from Venezuela, but that certainly adds some uncertainty to an entire region, does it not?
No, I think certainly that adds some uncertainty. The market's powered through it. And in the interest, I've been bullish for years now, John. Yes. But in the interest of taking the other side, I came prepped tonight with three things you and your listeners want to know that could finally cause the market to get disrupted. You ready?
I am ready. I actually like to see this other side of you, Craig. Tell me.
Number one, a steep rise in Treasury yields. And you're going to say, what could cause the steep rise in Treasury yields? It could be the Fed chair, or it could be a reversal of the tariffs, or maybe a combination of the two. I won't get more of it. It could be those Treasury yields and those bond vigilantes that get us in trouble this year.
Well, before we go on, I want to ask that because we might get a ruling on the tariffs as early as this week. Are you suggesting that perhaps if the tariffs are ruled, well, you tell me, which would cause the spike in yields, the Treasury or the Supreme Court ruling that the Trump administration can't implement tariffs, or that they can?
Well, I think to be clear, here's what's going to happen. I don't think the Supreme Court striking down the tariffs is going to contain or cause this big rise in yields by itself, right? But it could if you have a bad Fed chair and the tariffs get rolled back. You put those two things in play, I think it's enough to create some economic uncertainty relative to the strength of the fiscal situation in the U.S. that could cause those yields to spike, and that's really what worries me the most.
And the Fed chair term ends here in May. Okay, that was number one that could cause some unspoiling of the market. What's number two?
Number two would just be what we've been worried about for 3 years that hasn't shown up yet, which is a suddenly slowing economy, right? The bottom line to this one is this. As we start 2026, we still remain in this no one's getting hired, very low fire labor market, but that could turn quickly if we saw massive downsizing with the implementation of artificial intelligence, right? So that's event number two, a suddenly slowing economy that creates a growth scare because stocks are priced not for perfection, but pretty close.
Okay, yeah, I don't know how sold I am on that one. What's number three?
Number three could be, I think what people were doing some hand-wringing about in October and December is it would be the AI bubble and the AI enthusiasm finally bursting, right? I mean, Q1 earnings season is going to be fast approaching. There's going to be massive scrutiny on the mega tech cap firms specifically, looking at how hundreds of billions of dollars in capital expenditure is going to provide a clear positive ROI. So AI is real. The question is, are the hundreds of billions of dollars being invested in AI going to actually translate into real earnings per share for non-AI companies? That's what it's all about. Those are my three things that could take down Mr. Market in 2026.
If I were to bet, I'd say number three. And maybe that's just because I just am finishing up reading 1929 by Andrew Ross Sorkin about the speculative trades that happened, including the democratization of the stock market in the 1920s. We've had a similar setup. I mean, there's a lot of differences between now and 1929, though they said that in 1929, by the way, about differences from previous panics. Anyways, I guess that would be the one I would buy. If you had to pick one of the three, Craig, which one do you think is the strongest likelihood?
I want to be so clear. I'm not saying that any of these are going to happen, but if I had to choose one, it's number three, because it's the same thing that brought down the internet bubble back in the day. Everything we were promised, John, Bluetooth technology, B2B, B2C, all these different things that happened It just didn't happen quick enough to justify the spending back in the day. That's the same danger that we have here.
So maybe we take this into opportunities. Are these the conversations you're having at VestGen Wealth Partners? You mentioned these mega caps going to have to justify how much capital expenditure and how high their stock prices are. Should we be looking at maybe some small or mid-cap companies that are going to benefit from the use of AI without the noose of having to be the ones to make it happen? Do you see what I'm asking?
Thank you. I think 2026 is all about the market broadening and investors embracing non-mega cap technology. That doesn't mean you need to sell your Magnificent Seven or your Elite Eight or your Great Eight or any of the numbers and acronyms, FANG, that we've put on them. But I do think this is the year where you can see those non-technology companies benefit from the AI adoption they have, and whether you're finding those in small and mid caps, whether you're seeing them on the value side of the trade, I think that's where investors should be looking for part of their money as they rebalance their portfolios after 3 years of tremendous gains in technology.
I had an interesting text from the 630 asking to have me ask you if slow car sales would be a concern for the market. They still went up, I think, over 2% in 2025, which isn't gangbusters, but I think a lot of people, considering the concerns about tariffs, the fact that car prices now are over $50,000 for a new car, had worried that last year would be a real sore spot for the economy. I don't know if you have any thoughts on the car market, Craig.
No, I'm not worried about the car market. What I am worried about is getting housing moving again. And housing is, of course, an inventory problem because it's housing that fuels America. I mean, John, think about all the expenses that happen when people move from house to house, right? They recarpet, they repaint, they refurnish, they get window treatment, the actual cost of moving, closing fees. It's housing. And if we can get housing moving again, especially for individuals, not for the institutions who are buying up all the houses. The president had something to say about that this week. That would be a game changer.
Okay. We have two things to look forward to on Friday. One could be the Supreme Court ruling on tariffs. We don't know. It's speculative. There's a little ledger they put out that shows they are going to issue some rulings on Friday. So tariffs could come Friday. Also, the jobs report, Craig. I remember the days we were chatting where inflation day was like the Super Bowl. We all waited for the number. I don't think we're there yet for the jobs number, but that's, I imagine, the one that people have circled right now.
Yeah, everyone's going to pay attention to jobs because the Fed has clearly said they're abandoning the inflation mandate. Well, not abandoning it. They're not focusing it. It's all about the jobs, right? And when we get that jobs data on January 9th, I think we're going to continue to see some moderation in job growth. Hear me say there will still be job growth, but I think it's going to moderate, right? I mean, we may only print 55 to 60,000 new jobs, and I'm not going to be surprised at all if that unemployment rate continues to incrementally creep higher.
Is there a number that worries you? Anything over 5%, or have we just been so spoiled over the last couple of years in the 3s and 4s?
John, I'm sorry. Yeah, anything over 5 is my line in the sand, right? I mean, the real number is 5.1, but I mean, listen, once we start getting over 5, it's a change in the headline. And even though since 1950, that's a long period of time, this U.S. economy has run very well at a 5% headline unemployment rate. No one's used to that, and that will create a negative feedback loop, some negative psychology, and that gets into the consumer, and it's always about the consumer. That's why that brilliant listener in that 630 area code asked me about automobile sales.
Yeah, I should note it's 4.6%. That rounds up to 5, but that's still a long way from 5%.
We're a long ways from 5. Yeah, like if you printed a 5 on Friday, it's like financial Armageddon, but that's not happening.
Exactly. All right, hey, Craig, it's always good to chop it up. GetRetiredStayRetired.com. Quickly, Bears or Packers Saturday? Who's going to win?
Go Bears.
That's why you get to come back on. That's why you get to come back. That's Craig Bolanos, everyone. GetRetiredStayRetired.com.